you also have to know your limitations. And I think this gets to a point where it's just really, really challenging.
Only those who will risk going too far can possibly find out how far one can go.
Doogles.
This podcast contains the arguably witty banter of two friends, Skippy and Doogles, that like to debate about investing. The content is intended to be entertaining and for informational purposes only, not investment advice. You should do your own research and consult a financial professional before using any of the information in this podcast, and especially before investing.
October is wonderful because it's the start of Q4. As long as you go by the calendar year, October is the start of Q4, and it's kind of the beginning of the last hurrah. And I love what that does for the human spirit.
That's an interesting take. I'm always stressing about the finances of like, what revenues we got to pull in Q4.
No, don't stress about it. Don't stress about it. Be about it.
All right. That is good. I mean, that was this week for me too. It's like Q4, let's go.
There you go.
I'm on board.
There you go.
I mean, it's amazing. You can't even mention like the leaves changing or,
the leaves
fact that there's football on 56 straight days, and we also get some NBA and some hockey and it's a good time in the sports calendar. But for you, it's about Q4, Douglas. Good work.
I know nothing about any of these things. These leaves, these NFLs. No. Q4. All right, listeners, thank you. Another wonderful week we got here. SkippyDoogles@gmail.com is where you can send listener mail, which we're going to kick things off with. And remember, we got premium subscriptions going on. SkippyDoogles.supercast.com. Hit that up. You get episodes early. You get special episodes we release. We love it. Helps to support the show. Appreciate y'all. Listener mail time.
Listener mail time.
Hit the jingle.
They fight and fight and fight and fight and fight. Fight, 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 fight. The Skippy and Doogles show.
I'm gonna let you go. I'm gonna let you go with this one because you got fried up. FRIED up about this a little bit.
I'll give a quick intro, and then I want you to walk through the high level because maybe I missed a point. This is a great thing about having a podcast co-host. Like maybe there's something, but
could be.
I don't like this one. So I believe this is a shout out to Jonathan. Jonathan, you're great. The article you sent over got me a little fired up. The headline is actually called "Did Investing in Employees During COVID Pay Off in Firm Value?" Mumbo jumbo words there. I think what these Duke professors are trying to get to is, what was the outcome? Like COVID was a tough time to run a company for 1,000 reasons. But
Truth.
What a lot of executive teams were dealing with at the time is like, gosh, not only are our employees are dealing with all these things like maybe not coming into the office anymore, but also high stress levels, sickness, potential death of elder family member. Like it was a weird time. And most companies that had the ability to try to make financial investments in their employees to make their lives a little easier during this period. So this is just a high level question of like, was it worth it? What happened?
I'll add on one piece to that because you mentioned make their lives a bit easier, which is definitely a part of it. And during this period, you had the transition from power being held and concentrated in the employer, meaning you work on our terms, to power started shifting over to being concentrated in the hands of the employees. So it wasn't just, we want to make your lives easier. It's, we need you to work. And people, this is the great resignation time, not necessarily in 2020, but starting in 2021. So this period, you had great resignation. People were leaving. They're like, if I jump to this other company, I can get 20% more dollars. I'm going to do that. So how do we keep our peeps? Keeping the peepins.
This was a period where I saw pay raises unlike anything else I've seen in my career, right? 20 to 40% to keep someone all of a sudden became fairly normal, where 5 years prior, 15 years prior, you would have told that person to walk. Really interesting time. So I love the idea here of we want to test what happened and if it was meaningful. Largely, they go through and they try and explain the rationale behind how they wanted to test this environment. This is one professor from Duke and one from the University of Texas at Dallas. And they use a SEC rule about investing in, I don't want to go too mundane here, Doogles, but they look at human capital investments as reported by the SEC.
There you go. And it's, to be clear, it's not the amount of the investment, it's that the investment was material, which is certainly up for interpretation and subjectivity. But yeah, continue.
Yes. The major finding of this then ends up being, they end up saying they found that investments in workers' welfare increase firm value only in companies that had substantial cash holdings before the pandemic. So it's kind of like this caveat upon caveats of like, this might actually have been a wise investment for the company, because it's ultimately what this hypothesis is trying to say. Like, did investing in your human capital during this period pay off in a more valuable company? And they say a quantified yes if you had substantial cash holdings before the pandemic.
If you take, yeah, that's right. If you take human capital out of this and just talk about investments by a firm in anything, do you think that that same conclusion exists?
No, I don't. But calling human capital an investment is, you know, sometimes it's this fine line between like a tax and expense, an investment. Is some of this stuff for your employee who's not engaged is more of a tax. It's like you just have to pay this. And then for your people that really love and cherish the company, they might truly appreciate the additional benefits that get sent their way, and they might work harder because of it and be more loyal because of it. So it's a really tricky, I appreciate that they tried to do the test, but it's really tricky to have hard and fast conclusions on, I think.
Yeah, and the reason I asked, I agree. The reason I asked that question is because it's harder for me to understand why the cash balance would matter only in the case of human capital investment. That's where it because if you zoom out a little bit, I'm going to oversimplify this, but you zoom out a little bit and you could say companies that have higher cash balances are going to perform better than companies without higher cash balances. And so I'm like, does the fact that you're studying human capital investment matter for the conclusion? Or is it companies with higher cash balances also, if they brought frogs into the office, they perform better than companies without high cash balances that brought frogs into the office?
I love that point. I think this idea starts from a logical and reasonable place. But if someone said that before they did this, if someone said, hey, my hypothesis is I think companies that have a lot of cash are better than companies that don't have a lot of cash, that might just be the overlying factor here, because companies that have a lot of cash probably have a lot of cash because they're profitable. Companies that are more profitable are probably more likely to ride through COVID. Companies that are more profitable probably can pay their employees better, and so they have better returns. Yes, we won't even dive through the rest of the minutia here in trying to come to a reasonable thing, but we are going to go to the last few paragraphs, and I'm just going to throw up my hands in exhaustion, and maybe you can help me here. So the last part of this write-up says, should companies have more reserve cash for rainy days?
Yep.
The main author closes with a quote that says, you can imagine investors complaining about firms that hold big cash balances because they're not investing. Now, it turns out if COVID hits, then you're in good shape. But the rest of the 99 years when COVID doesn't hit, are you optimizing firm value or not? That's the long-standing debate. Does this guy know what a rainy day fund is? I don't know why this frustrates me so much, but it's like, yeah, if you're truly saving for a rainy day, you are expecting it to not be valuable the majority of the time. It's only when, unfortunately, there's massive floods in North Carolina and Tennessee, or COVID, or there's always some new crisis that you can't anticipate. But if your goal is simply to optimize firm value with financial metrics, one, you should have a lot more debt than you want. I think this, to me, goes back to the Japanese companies that have been around for 1,000 years plus, and the studies that have been done on those, and effectively they hold too much cash in quotes. What is the desire of your company? How resilient do you want your company to be? This is not a something that should be optimized. This is something that your executive team needs to decide in terms of how much resilient you want. Because do you lose a few percent return on equity or something if you hold too much cash? Absolutely. But that can be a conscious decision that a company makes to be more resilient for when COVID hits. And I'm gonna stay on my soapbox for 2 more minutes here. There's companies that have talked about, you know what, we didn't have any debt going into COVID. We held a little too much cash, and coming out of COVID, we took 30% market share because our competitors had to lay off a bunch of employees because they had to service their debt, and their product just fell off a cliff. This ending just really drove me crazy. I don't really understand what he's even trying to say. Yes, it's a long-standing debate. It's come on, dude.
Yeah. Yes, I refuse to believe what I'm about to say is true, because this is a professor at Duke, and so I don't think that they fell into this trap. But it reads as if they fell into the trap, the academic trap of when you're studying a specific point in time, you then extrapolate that as if that is human history. And so meaning this, if this study had been from 1900 to 2024, we were analyzing companies, and there was this one event that occurred in 2020, and companies had been accumulating cash from 1900 for this one moment, then I'd go, this paragraph makes a lot of sense. But you could probably go back 3 years, 5 years in a company's history, and that cash may have also been helpful because of an industry-wide event or something of that nature. It's not as if this was the only moment in time where cash would be helpful.
Like when oil prices went negative briefly.
Exactly.
I mean, there are so many. There's at least a once a decade crisis in almost every industry. And the reason they didn't do that, Doogles, but I think this speaks to your point, is because the reporting on human capital investment only started with the SEC in 2020. So they don't have a long data set. But I think all those things, as much as I thought the article was really interesting, as much as I kind of believed the conclusion, but when I got to the end, I just went, this is way too academic. Like, this is academic fantasy land. This doesn't help people actually running companies. Because it's not, no accounting professor, whether you're at Duke or anywhere else, is going to tell me how to run my company. Like, it's just not going to happen. All right. Is that too strong? No, me and my leadership teams are going to come up, like, I'll move on. Thanks for the listener mail, though.
Yeah. Appreciate it, Jonathan. I'm going to use part of this to transition into the first fishbowl topic.
Okay.
And that is this piece from Graham Duncan. It's called The Playing Field. Graham Duncan is an investor, runs an investment firm, and is also co-chair of the Sohn Conference, which we brought up a few times here. The connection that I'm going to make is around, well, you'll feel it. You'll feel it. Let me not ruin the punchline here. So what this piece is about is Graham Duncan saying over the last decade, he's interviewed a whole bunch of investment managers. He's saying more than 5,000. That's a lot. I don't know what else he was doing when he was not interviewing investment managers, because that's a lot of people. Anyway, for example, I'm just going to do some quick math. 365 days in a year, 10 years, you get 3,600 days. So it's more than one interview in a day. This, more power to you. All right, anyway, I'll move on. There's this quote that he kicks it off with, which I enjoy, from Kwame Anthony Appiah, I believe is how you pronounce that. In life, the challenge is not so much to figure out how best to play the game. The challenge is to figure out what game you're playing. The reason he raises that is because he's saying, as if investors move up level, and I'll talk about the 5 levels in a second, as investors move up level, what they do is they understand the playing field. That's why the title is like much better. They understand the game that's happening, and they're not simply just, I say, playing whatever game is dealt to them. They can look at the entire chessboard, create their own rules in certain cases, etc. Here are the 5 levels. Apprentice, which is you're learning the game. Expert, you're mastering the game that you were taught. Professional, making the game that you were taught fit into your own strengths and weaknesses. So that's when you start to get creative.
Mhm.
Master, which is changing the game you play as a part of your own self-expression and operating at scale. And then last is steward. That's basically when you're giving back. It says you become a part of the playing field and mentor the next generation. So those are the 5 stages. I want to spend some time talking about a couple points that I saw within the master category. There's much to see in the other ones, but this master category is where it's the step before steward when you're giving back. So this is like the best in the game where they end up landing. So very few people end up making it to this place, but it's when you take your creativity, start to change the entire game, and you can do it at scale. Anything else, questions, anything else you want to hit on before I hop into this section?
Well, I see that you just wanted to talk more about David Tepper, which is a little disappointing to me.
It's gonna happen. It's gonna happen.
Thought we got off that. It's an interesting way to do it. The question that comes to mind, and I imagine could get there, is like kind of why do I care? That's one question I have. And then the second is if you think of this as a sales funnel almost, and maybe people aren't striving to be a steward, but people are trying to move through apprentice, expert, professional, master. He doesn't really, I don't think, tell me if you read it differently, like tell you exactly how many people make it from apprentice to master. I mean, I agree that it's very few, very, very few, but he doesn't structure it that way, right?
No, he does not.
Okay.
He does not. So it's not a full funnel that he lays out. But your question, why does it matter? Was that the there are 2 different sets of takeaways that I have here at the high level. So not what I'm about to touch on. One is getting a better understanding of the fact that there are these different levels. Here's what I mean by that. If you go back to the conversations that we were having about 2020, we've talked about this a few times, when people were basically like, every day up and to the right, every day up and to the right, I'm at master level.
Yeah.
You go, no, not exactly. So there's like one category to say, understanding that the levels do exist and there's differences, whether or not the way he states it is exactly what those differences are. There are differences between them is an important thing. And so if you are not at the professional master level, buy an index fund and, play around with a little bit of money if you want to on the side. Like that's one point. The other that I found interesting, this is what I will dive into, is I think some of the key principles, no matter what level you're on, that the masters have are good to keep in mind, or I enjoy keeping them in mind. People don't need to keep them in mind, but I personally enjoy keeping them in mind. And so that's what I hit on.
He doesn't necessarily put a time period against these levels, but the way I read this, I mean, like you couldn't even be in that professional or master category without decades of experience in the game. Would you agree?
Yeah, that's right.
Okay.
That's right. You wouldn't know. Well, you could think that maybe you were, but you wouldn't know.
Yeah, you'd be fooling yourself. All right, so tell me about master. I'm curious.
All right. So first, there's this T.S. Eliot quote, which you may hate. I love it, and you'll hear this in all the things that we talk about, even outside of investing here. So T.S. Eliot has my favorite quote of all time, and he might be adding this as one of my top 3 as well. Only those who will risk going too far can possibly find out how far one can go. The reason that I shifted before from saying these are good to keep in mind to I enjoy keeping them in mind is because you could take this quote and do some stupid ish with it.
Yep.
But for me, the reason I like this is because I like trying to figure out human potential and maximizing what that is, both for myself but you have to be so conscious in order to manage this well. But I loved it. And the opposite of this to me is when you set your own boundaries based on what you've seen before. And to get to the master stage here, you can't do that. That's basically, if you go back to what I said around the expert, which is that second level, it's mastering the game you were taught. Mastering the game you're taught, it's not this, right? Like that's just, there's a game on the field, someone showed it to you, you're following a playbook, and you're good to go.
This is imagining how the game will evolve, even if you haven't seen it, and playing that like chessboard, right?
Exactly. Now there are these 3, I'll call them attributes that he mentions that he's found that people at the master level have, and I want to walk through each one. The first he calls open-minded with a point of view. I've heard some version of this called different things before. Like a strong opinions weakly held might be like a different version of this too. But what he's saying is that when you get to this master level, at one moment, you could be focusing on the business, which you always talk about how investing in stocks is investing in businesses. So at one moment, you could be focused on the business. Then you could switch your perspective the next moment to see the business as a stock. And then you can switch again to identify moments in time when there's something that's going to drive an entire market. I think this is really interesting. And as like your standard investor, don't worry about any of this. Like this is not the way to think about it. But when I think about masters and even the Tepper interview that we talked about last week, I'm going to walk through each of these points again.
Yeah, well, hold on. I mean, so my PSA there, I know we have professional investors that listen to the show, but like if you're casually interested in investing, you probably don't even strive your entire life. You don't even strive to be a master. So I just want that PSA to be out there. This is very niche, very fascinating and valuable stuff that everyone can take tidbits from. But like, this is 0.05% of the population, maybe less, right?
Yeah, that might be too high. Fully agree. Okay. I think it's a great PSA. So I want to break each of these three components down again. So first, you can be focusing on the business itself. Simplifying this, I would call it, this is looking at the fundamentals. This is a company who has been running well. They've been saving up their cash. They've got minimal debt. They pay a solid dividend. They've been growing at a good rate. And the valuation of the company is low relative to what I believe it is. Like that is focusing on the business itself. Then switch perspectives the next moment to see the business as a stock. My interpretation of this is where you say, okay, fundamentals aside, there is something that the market is telling me about this asset that is going to drive the asset higher, independent of whatever the fundamentals are. This could be, sorry, go ahead. You look like you want to say something.
No, so I want to quiz you on this. I think of this as when I buy tow truck company in the middle of Tennessee and I hold my nose the whole time. It's just a fundamental play. And I'm like, I have no desire to own this thing, but it's cheap. Versus when I buy like, I don't know, Diageo or Nike or something that I'm kind of excited about being a shareholder in. Is that how you think about it, or am I internalizing this too much?
That's one way to think about it. And I don't know exactly what he means, but that's not the way I interpreted it. But I think that is one way you could think about it. I interpret this more as the first is more fundamentals, and the second you could think of as more of like a wisdom of the crowds, momentum. Like it's not pure momentum, but like a play where you're just saying, like you could buy. If I take this away from the world of equities, like Bitcoin probably falls more into the second category than the first. It's more speculation potentially.
Yeah, I mean, I kind of think in the world today, this would be like you found an AI company that you like the fundamentals, and then people talk about this big macro cycle and AI investors. So that'd be like the second piece of the stool, the second leg of the stool.
That could be it. And then to go back to Tepper here, the switch again is to identify moments in time when one factor is driving the entire stock market. This is what Tepper was talking about with China last week, where he went, US is lowering interest rates. I'm buying everything in China. This is that point. So it's not just about, I should say, the businesses themselves, although he did look at that. It's not just about any individual stock. You just go, this is the moment to hop in.
Yeah, there's a reason. I love that we're talking about this on the show. I'm not throwing shade at you, but there's a reason I gave that PSA. And for me, when you have to do all these things, some qualitative, some quantitative, some macro bet, some like, this ends up in the too hard pile for me. You know, I'd like to think 40 years from now, I maybe end up in the master category, but you also have to know your limitations. And I think this gets to a point where it's just really, really challenging.
Only those who will risk going too far can possibly find out how far one can go.
Doogles.
No, I completely agree. That's why people are not your PSA again. People are not and should generally not strive to get to the master level. This is a different level of thinking. I just find it to be intellectually fascinating.
intellectually fascinating. But the thing that always gets me when we talk about something like this, let's pretend that someone like David Tepper can make 17% a year on average. You can do a lot simpler analysis and end up making 15% a year on average. And sure, you end up less wealthy, but you still end up in a very, very good spot. So I just say you can decrease the difficulty by 10 times and still end up in a very, very good spot. But maybe I'm biased here.
With one caveat. One important caveat is that when he's talking about masters here, he's also talking about at scale. So this is being able to do this with 50 billion, $100 billion. And I have never and will never operate at that level of scale. And so I do not know if actually when you're deploying that much capital.
Fair. Very fair.
Yeah, might be a little different. All right. The second attribute, relationship to time. This one, there actually might be some more lessons for that us everyday folk can take into consideration. So he's saying that if you're skilled portfolio managers, at times you have to you operate with a sense of urgency. So you want to pull your long time horizon forward a bit. And then sometimes you got to operate with a sense of patience. And I like this one. They wait to participate until the moment of sharpest appreciation or decline in a given security. That last part, I like that. Most people should not think about that component in particular, but it's fascinating as I think about the highlights. When you bring up the highlights of some of the top investors ever, you can see that very clearly. In like, there are times, what is Buffett doing right now? We don't necessarily know. He may have just forgotten that he has money, but most likely what Buffett is doing right now and accumulating all of his cash is he is waiting to participate into the moment of sharpest appreciation or decline, either in a given security or in a given market. And that is why he is hoarding cash. That is most likely what it is. Something that's fascinating. Here's the second one. This one I like more for the everyday. Good investment management comes from a mindset reflecting the assumption that the manager will be investing for decades, but that investment activity is as a series of sprints and recoveries rather than one extended marathon.
It's interesting language to talk about volatility.
Yeah. Sprints and recoveries, not one extended marathon. Because I love that you framed it that way. If you take the market is up 7 to 9% on average over the long term, that is not, when you look at any given year, it is up 7 to 9%. And when you think about a marathon, if someone's running marathons, let's say they're a fast runner, you're running marathons and they're like, I'm going to get 7 to 7:30 per mile for the entire 26 miles. And it's not like they're running a mile at 4 minutes and a mile at 20 minutes. They're running pretty steadily, saying that's not the way that the market operates. It's really a series of sprints and recoveries. I like that one. This reminded me of China last week. Now, I'm sorry that it's a quote from Lenin, but it is. There are decades where nothing happens, and there are weeks where decades happen.
I mean, all I know is I figured this investing game out, Doogles. You just buy something, you let it double, you sell half. It's so easy. I don't know what, yeah.
That's it. You print attendees.
China's amazing. That's all I know. Yeah.
All right. Now I'm going to get real direct with Tepper, and then we can move on. Relationship to risk is the last attribute here. Here's what Tepper says. We're value-oriented and performance-based like a lot of funds. But I think what differentiates us is that we're not afraid of the downside of different situations when we've done the analysis. Some other people are afraid of losing money, which keeps them from making money. Tepper, that is Tepper all day, every day. And do not follow that if you are not at the master level. So that's what I'd say. But it so describes at least my understanding of how he operates. Go on.
I mean, Buffett, Marx, etc., say something along the lines of, we prefer a lumpy 15% over a smooth 12%.
Yep.
It's saying something very similar, if not the same. Yeah, most investors' psyche is not, they don't want a year that's down 30% because their emotions get to them and they end up selling and then they never make the upside. I think David Tepper has proven that he can ride through those storms.
It's tough. This brings me back to the poker table. You're pre-flop, you got pocket aces, let's say I'm just going to make up a number. You have $500 in front of you just to put a number out there.
Mm-hmm.
Two people before you go all in. In order for you to call them, you have to go all in. You can either view that situation as one where, but if something happens and something goes wrong, I could lose $500. Or you can view that situation as I am guaranteed to have the best hand right now. Like this is the right move to go all in. And there's one side of that is thinking about the downside risk, and the other side is saying there can always be downside, but this is the right play given the analysis. And that's not always that's not always easy to do. That's similar to what we're saying here.
I fully understand what you're saying. I hate the poker analogy there, because there's so many options in investing to sit on your hands and say this isn't the pitch for me.
Same with poker. You can fold.
Yeah, but I don't think there's a time where your average investor or even your professional investor, your level 3 investor here, using Graham Duncan's terminology, like should go, using your terminology, all in, right? All in.
Fair.
It's not language that works for investing, because there are aspects of diversification that are a free lunch. So I just push back a little on that. Yeah.
All right. Fair enough. All right. What's in your fishbowl?
Now that interest rates pulled back slightly, the Financial Times did a rough analysis of how much money they think banks have made with elevated interest rates. And it's over $1 trillion. To me, that's interesting. We talked about this as rates were going up. Here's the actual stats for you. Even when rates went to 5.5%, large banks like JP Morgan and Bank of America paid roughly 1.5% of annual deposit costs. So that spread, right, is money they're making. Now, a lot of this money moved to money market funds to exploit that. But it's just funny that we seem to have gone to the top of the cycle here and are headed back down. And the biggest banks like Chase and Bank of America held strong and never really increased rates to a spot that was fair market value. And in doing so, they made $1 trillion. It's a fascinating case study because I've been wondering if your average deposit holder at banks would force their hand. And it seems like we've gone through this cycle. This is not how it worked in the 1980s, right? If the Fed funds rate was 14, banks paid something approaching that. They didn't just keep your checking account at 0.01%. And we seem to have made it through this cycle with the largest banks in America saying, no, deal with it. We're going to eat this spread. And unless you're super savvy.
Do you know that what you just said was true?
With the 1980s?
Yeah.
So I haven't done a case study. I know what I said was true in the sense that it is an entirely different banking environment, right?
Yeah,
you know how many
true.
small banks there were in 1980? So the level of competition with this credit union, this town's bank, this state's bank, like there were just thousands upon thousands of more banks. So at least people were competing for those funds. And I think in this super cycle, you saw some of that with like your local credit unions advertising decent interest rates. But the too big to fail banks have another competitive advantage where people aren't banking with them for the sole purpose of making a nice return on their cash. So yes, I can dig in. I can do some analysis on that, but I'm pretty confident in that it's directionally correct.
Yeah. Okay. No, that the macro that you described makes a lot of sense. And so I can buy into it. I wondered.
Yeah.
Makes sense. Okay. Keep going.
So to wrap it all up, during this period when the Fed funds rate was 5.5%, the average interest rate was just 2.2%. And that discrepancy results in a total difference of 1.1 trillion in excess revenue for the banks, according to the FT. It's a huge number.
That's so much. It is. It's a lot of money, and it was so blatant and in like not that we would get to this amount. Like who knows where it add up to, but there was enough written about it, and we talked about it enough that it was happening. It is kind of wild. And I complained to you about my Bank of America situation.
Mm-hmm. I mean, that's 1.1 that's $1 trillion that didn't flow to the consumers of the US economy.
Yep.
This is
That's
not,
right.
a lot of this is
Yeah. I get it.
business cash positions or whatever, but like the banks just held it because they can. Uh, they're like bargaining power. Again, that's not why people are there, but it's fascinating to me. And I've always been incredibly sensitive to this. I think your average person is not. So it just doesn't matter. But
They
it's
are.
crazy to
They
see.
are once they find out.
Mm-hmm.
The number of people, and I'm going to extend this beyond the conversation that you raised up. But if I just abstract this out to the idea that you have money that you thought would be doing a thing that is not doing a thing, it impacts a lot of people, and they actually are sensitive to it when they realize. An example is I've seen and heard too many situations of people putting money into IRAs and thinking that it was invested.
Oh, without actually
Yeah. It's
taking
like
that next step to
I,
get
I
it
put my
invested.
money, I put my money in my IRA. It's like, oh, well, what did you invest in the IRA? Oh, what? Excuse me? Right? I've heard it happen with
Wow.
both just putting the money in the IRA for years as well, just putting money in the IRA. And I've also heard about it from people rolling over 401ks into IRAs and they're just like letting it sit. Like you roll it over and you go, I'm good to go. And in much more tied directly to what you're talking about is people assuming that their banks, when rates go up, and not that the Federal Reserve, when it talks about interest rates, is really talking about the federal funds rate. It's talking about the rate at which banks are lending to each other. Does not have to impact the decision per what you're talking about that JP Morgan makes, that Bank of America makes, that Wells Fargo makes. But there's just an assumption. I have my money in a savings account. Interest rates were low. I get that it doesn't pay anything. Oh, now interest rates are higher. And then you check 3 years
It still
later
doesn't pay anything.
and it
Yeah.
still doesn't pay anything.
It's fascinating to me because I think this tells a little bit about the core identity of a company. So with brokerages, Vanguard or Fidelity or Interactive Brokers, there's more. If you have cash sitting like ready to invest, they will automatically, at least in my experience, I don't want to speak broadly, but buy money market funds with that cash. So you make the 4 to 5% return. Like that seems like being a good steward of your money. Charles Schwab
Does not.
if you buy their robo accounts, or yes, it does not, they take that spread. They've done, and they will advertise this to brokers that's one of their financial innovations. They take the spread on that cash and use it to pay their operating costs. It's interesting. Banks the same, right? Your local credit unions often are trying to pass a little bit of that rate rise along. And Chase, I watched Chase the whole cycle. They just went, nope, not happening. I mean, they're sitting there laughing at you.
Yeah, I mean, yeah.
Seriously,
Like
yeah. You
we are
can't get
here.
another bank
We are
to do
here to
this.
optimize for us.
Yeah,
You are there to optimize for you. If you choose to bank with us, then you're choosing.
we're
to make
still going to charge you a
0.1%.
$20 fee to do anything fun.
Yeah,
Like,
yeah, exactly. All right, I've got a really super quick hit, super duper quick. You may not care at all about this, but ironically, given what I'm about to say, this made me giggle. I'm about to talk about Giggle Academy. Okay, your good friend CZ, formerly the CEO of Binance, was imprisoned. Some might say fairly imprisoned. He was imprisoned. I love this quote from this is not a CZ quote, but it's a quote from an article. It's a TechCrunch piece. Shortly before his sentencing, CZ announced his next project, Giggle Academy, an education platform that claims to bring in no revenue. He'll be free to spend his days working on that company now, which is actively hiring.
yeah, this is the next OpenAI. I bet it's a nonprofit too.
It is. It is. I read the concept paper on it. It is a nonprofit.
What, out of curiosity, what does Giggle Academy do?
You can think about it as like an open access education platform. It's geared for those that ordinarily may not have access to educational resources that other folks, more privileged folks, do. So it's trying to democratize education. It's like the central part of it. One part of the concept paper that stood out to me was it was like the why do this?
Mm-hmm.
And he basically says, I'm super talented and super bored.
Props. We appreciate you trying to get back on this show. Let me tell you, that's great. Douglas, all these education academies are awesome. I love the concept. What I learn more and more is that like your typical university in the US or abroad, they're not just educating folks, they're also providing status, right? The degree from Duke. I don't know how I'm not saying that's fair. I'm not saying that's right, but I don't know how you get your educational technical training and also provide some of that status that comes with the degree.
Yeah. It's super hard, and not just a degree. I agree with your degree point. It's some form of recognized credential as currency. And with Giggle Academy, instead of you getting the degree, you're going to get giggle points and giggle badges.
Wait, you're not joking right now?
I'm not joking right now.
Yeah, when I walk into the CEO and go, this guy, we have 10 talented candidates here. This guy's from Duke, this guy's from UT, et cetera, and this guy has 100 giggle points.
Yeah, option C, please. No, I think your point is absolutely right. And the reason I said not necessarily degrees is because you can also think about like in trades. But in trades, you get the certification, then you have to go down the process of being an apprentice. Like there's steps along this credentialized journey. Yeah, I don't know what he's doing with his Giggle Academy, his Giggle points, but I hope there's no fraud. Like that's the minimum that I ask of you, CZ, is that this does not end with you going back to jail for something related to fraud.
That seems fair. Official stance on the show. Please don't commit fraud. Okay.
Check.
I think that's it, right?
Yeah, I think so.
Awesome. Thanks for hanging out with us today. Hit skippydoogles.com for all the articles we talked through and all the other goodness related to the show. We'll talk to you next week.
Bye-bye.